Let's go. Let's go. Welcome, everybody. Happy Monday. It is the first live stream that we're doing in the Profit and Cash Flow Mastery for Truck Fleet Owners. And let's go. We renamed our group here because we're focused on making sure that you, the truck fleet owner, has all the tools, all the strategies, all the tips, tactics, resources necessary to thrive in trucking, have more cash in the bank, have more profits at the end of the day. Really good to be with you on a Monday. So let's get into it, guys. Let us get into it. Boom. Hello and welcome. Guys, it's March already. So March is coming up on the last month of the quarter of 2024. This year is flying by. Where are you at? What are you doing this year? How have you been doing? What's your production like? How's your performance in your business, in your trucking company? Talk to me. How's it going, guys? And wherever you're chiming in, definitely you can use the chat to chime in. If you're not watching live, you can always leave a comment, and we'll do the best we can with getting back to you as fast as possible in terms of where you are with things inside of your business, inside of your fleet, whatever you're up to. Guys, we're coming up on the last month of the first quarter already. Come on, man, let's go. I'm hoping you're doing well. I'm definitely excited about what's happening here in 2024 for our ecosystem, the people that are attached to us, our company, and what we're up to. And I hope you're feeling the same. Okay, if you're in this call, I hope you're doing well. Hope you're doing great this year. Hope you're accomplishing everything that you want to accomplish in 2024. All right, so let's get started, guys. My name is Cheston Bulgin. Just in case you didn't know, I am the senior consultant, CFO, and founder of By the Books Consulting. You can reach us at 888-4BTB now. That's 888-428-2669. That's toll free during business hours. And you can also reach us on the web at bythebooksconsultants.com or at youraccountingsuperhero.com. And you can also reach me on my email if you want to reach out directly. That's Cheston at bythebooksconsultants.com. And we help people, truck fleet owners and small businesses, some other small businesses in the area of accounting, QuickBooks, tax strategy, tax planning, business advisory. We help out with making sense out of the number story, create peace, ease, and clarity when it comes to that, so that you have the proper systems in place to make it easy for you and have real clear, actionable data to get the results that you're here to get. Okay, that's kind of what we do. And real quick, I just want to get into today's conversation. And I believe we're talking here. This is what we're talking about today is cash flow, man. Cash flow. Okay. Now, when you're running your company, when you're running your trucking business, the cash is king. It's really the lifeblood of your business. And you want to make sure there's enough of it at the end of the day. And what I want to say is that there is a definition of cash flow and there's a definition of profits. They're not the same thing. And you probably realize this by asking yourself the question, well, my financial statements are showing that I made money. Where is it? And where is the money that I made? So sometimes there is some confusion about what makes up cash flow, which means more cash that you're able to realize in the bank at the end of the day versus how your business is performing profitability wise. We want to take care of both when we're running the business. We want to make sure we have structures, systems, and actions to manage both. And if I were to choose one above all, cash flow is everything. Front end revenue is also up there, like how much revenue you generate and bring in, because at the end of the day, that can translate into cash very quickly, depending on how you're set up. Okay, so this conversation today is going to hopefully give you some real good idea and some actionables on how to manage your cash flow in your trucking company when it doesn't make sense. Okay, so first I want to make sense out of this in terms of what cash flow is. All right, so we're going to distinguish what that is right now. And if we're looking at cash flow, it's broken up into three different categories. Three different categories make up and impact cash flow. Okay. So the first category is what we think about the most. We think about operations like income and expenses. If you go out there and you're running your business and you're providing your service, right? So no matter what sector of the trucking industry you may be in, but there's always the process of getting an order, like and transporting something from one place to another. Okay, that's just the job inside the industry. So you provide that service, and you're doing that a lot for your clients, your customers. Okay, and then you give them all your paperwork to prove that you did what you did, so that they can now pay you. They don't pay you first. You have to do the job, then prove that you did the job. Send them the paperwork and say, okay, pay me, which is the invoice. The invoice is just a documented contract that says, okay, please pay me what you owe me now. All right. So you do that along with all the other documentation that you needed to prove that you did what you said you would do. And then you give it to your customer and they say, okay, wait. Okay, wait. All right. So that's what we know. A lot of the times they're not going to pay right up front. They're going to pay 30 days, 60 days sometimes, maybe 45 days, maybe even 90 days later. You'll get a check in the mail or you'll get an ACH deposit saying, okay, we finally decided to pay you for the work you did way back when. All right. And that's usually how it goes, man. And it's fantastic. It's great that we're able to go out here and generate money and revenue for the company and do it on a high level, because some of you may be really good at operations, doing what you do, getting the guys out there into the field, right? And making sure that you're able to dispatch everybody, get all the people out to where they need to be on time and do the job that you do and do it fantastic. And then at the end of the day, you're able to submit paperwork, right, with everything that you need. And then you wait. You wait to get paid. In the meantime, there are all these other things that go along with the business in terms of outflow, like your drivers. They want to get paid, right? They don't want to wait 90 days to get paid for the work they did this week. It just won't serve them, right? They have bills to pay now, right? You have bills to pay now. You have suppliers that may want to get paid in less than 30 days. They may want to get paid as the job gets done. They may want to get paid in 30 days when your customer pays and 90 days later for the same job, right? So all those things are there. You did your job. You did fantastic. You did what you were supposed to do. And then you have to wait. And then you have the obligations of paying out all the obligations that you have for the month while you wait. All right. So this is what we're feeling. We're feeling the pain of that. And if you're in the business for any amount of time, you know that's what you deal with. Okay. All right. But the cash flow from operating, we want to make sure that if we're looking at cash flow from operating, we're optimizing it. There's some things that we can do. There are actions that we can take in order to make sure that we can get this to the plus as much as possible. Okay. All right. So one of the things is making sure that we are mindful of how much we take on in receivables, because it may be an operational capacity issue at the moment for you to take on more so than what you can manage. That could be the case, okay, in one aspect. That could be a slow route for a lot of people to grow at the pace of what their operating dictates in terms of cash allowed to operate and pay for doing the jobs that you are hired to do, okay, whether it's paying your fuel, your maintenance, all your rent and fixed cost, your driver costs, and other costs of revenue, and then operating expenses. Okay, so you have all those obligations, and a lot of the times it may be the case where if you're taking on too much of direct costs that are associated with you taking the job, it's going to have a negative impact, because the amount of accounts receivable, like the debt that you take, like that people take on with you, which is what accounts receivable are. Like you're actually assuming, like taking on debt, like they're in debt to you, right? You're lending money, you're lending your services, which is another form of lending money, right? Now you're lending that, but then at the same time, you have all these other costs associated with doing that, and then some. Okay. So if you want to make sure that you're tight, you want to look at, well, how much is it that I can afford to expense out? What are the projections of my cash on hand to take on jobs right now, right? And then you want to take on the jobs that are correlate to the amount of um, debt that you can take on from your customers. Okay. And so if you're going to go down that amount, you make sure you can pay the amounts that are associated with that job, no more. Okay. And if you can get that right to the optimal amount, that will be the perfect concept, the perfect idea. All right. So you just know your capacity in that respect. But what if you want to grow fast, right? You don't want to be limited to the amount that you're just able to take on, in terms of the amount that you're able to pay. So there are things that you do. You've already been doing them. You've been doing them like without the general understanding, most likely, of the impact of doing it, but you've been doing it nonetheless. You've been taking on maybe credit lines, right? Credit lines is another way to manage cash flow from operating. Um, Credit cards are another way to manage that. Factoring, right? A lot of trucking companies use factoring services to manage the cash flow, but don't necessarily realize the impact all the way around of doing these things, or how it's their operating, like the function of the operating that really dictates the amount that they want to take on in these other short-term liabilities to cover cash, short-term cash, right? It's actually eating away at the profitability of the company, and it might not be necessary. Okay. There are things that we want to look at. We want to understand like the number story to the T. When I go out and do a job, how much is it going to cost me to do the job? How much is it going to cost me to pull this load? All right. So you want to understand that on a microeconomic level. So every unit that you have, you know that it costs a certain amount to do this specific lane or this specific load at this weight, this lane, this equipment, this driver. This is how much it costs me to produce that. Okay. Now, if you look and see how you've been managing cash up until now, is it reasonable for you to take on more so in capacity than the numbers dictate? Most likely, it's not necessarily reasonable to do that. You want to know where you can stay in, like your lane. Now, what I want to bring us into in this conversation is, well, how do you know? How do you know when is the time to actually go out here and expand aggressively? At what rate you should expand if I'm thinking about making sure I'm staying within my lane when it comes to capacity, right? You see what I did there? Stay within your lane when it comes to capacity, right? All right. So yeah, you want to be on top of this, guys. You want to know. You want to know how much it costs you, right? And then from there, um, at the same time, you want to be able to understand, well, what does it look like to take on um, cash flow in other areas in order to supplement the cash flow from operating. Okay. Because this is just one area that we're looking at. Okay. And really, operating really deals with the revenue generated, right? How much money you're bringing in, how many loads you book. All right. But then how much do you take on in accounts receivable, right? How much you're expected to actually get paid on that accounts receivable. Like if there's a trending factor, maybe you only get 90% of the revenue that's billed out on average. Maybe you get less, right? But if you're not looking at that, you won't know. So you want to be in reality with it. Well, how much are you really getting in the accounts receivable, right? So you want to know that. Accounts payable. Well, short term, like no. So what are your short term bills that are coming due in the next 30 days? That's a part of your cash flow from operating. Okay. All of your expenses in terms of your drivers, your fuel, your maintenance, all those little outflows that it costs you to perform the task at hand, like do that load. They're a part of your operating cash flow, your cash flow from operating. Okay, so we want to take all that into consideration, even your fixed costs, like if you have a building and site fees that you need to pay, you have permits. And all of those other fees that you need to pay, you want to understand what those numbers are, so that you can really be in reality about what this impact is on your business, what the impact of cash flow from operating is on your business. So what do we want? What's the thing that we want from this? We all want to have more money at the end of the day than what we had before we started. That is what we really want. So each and every one of these components of cash flow, the idea is to see how it is that I can have this be a positive to my bottom line month after month after month. Sometimes it's not necessarily bad for it to go into the negative from operating. It could be a sign of expansion. It could be a sign of expansion. It could also be a sign of inefficiency, right? So if you are, for example, you could have taken out loans like your credit line, like you have a credit line that you've been using like the previous month, and then this month, you are not really doing a whole lot of volume in loads. So you're not bringing in a whole lot of new revenue, so you're not building up that accounts receivable anymore. And at the same time, you are paying down the credit line that you took out from the previous month. So that's an inefficiency, okay? Because you're actually going negative in cash flow, right, per se, over time, right? So you're paying down this credit line, which is impacting your cash negatively. Your accounts receivable is actually impacting it positively, and you're not able to see that clearly because it doesn't look like that because you're not generating any revenue. But because you're not bringing on any accounts receivable, it's not looking like you're taking a hit to operating. By the way, you take a hit to operating when you take on an invoice. When you have an accounts receivable because you did something and you did not get paid directly cash for it. So it's a negative impact to cash, right? So when you don't take on loads in a particular month, it could look like, okay, I just got paid a lot from clients from the last month, right? The money's coming in, so I'm paying down my credit lines, but then I'm not taking on any new business, right? So that's still going to be a negative overall impact. It might not look like it, but it's negative, okay? Now, guys, I want this to make sense. I know I get sometimes I talk here about like numbers and financial metrics. And it's like, man, what is he talking about? What is he saying? And I just go off a tangent, man. I just start speaking about this. And my goal here is, guys, is to make sure that when we have these conversations, when we have these live streams, it really does make sense to you. Okay. That's my goal. All right. So if there's anything that we're sharing here, you want me to slow it down or break it down or talk about it another way so that it's very simple, just let me know. Even if you're watching this afterward on a recording, like on a replay or whatever this is, I want to make sure you know exactly what I'm speaking about and exactly how to use this to improve the performance of your business. Okay. That is the intention. All right. But bottom line, what I want you to be left with here is that we want to make sure that each component of our cash flow is optimally working. It's working in a way that serves us, which means at the end of the day, it puts more money in our account than it did before. Okay. All right. And it's a dance, guys. It's something that we want to constantly look at because it's a moving organism. All right. Because every time we do something, it impacts what's happening here. And then the idea is to choose our actions in a way where it actually improves this. All right. So every action we take, every decision we make, it wants to serve to make sure it's improving our cash position. Okay. That is the intention. All right. So that's operating. Again, these are the things that impact it. So accounts receivable, accounts payable, depreciation, prepaid expenses, current liabilities, taxes, those things like expenses, other expenses that come out, they are impacting your cash flow from operating. Okay. So if you look here at this financial statement that has JB Hunt on it, you see the revenue is 13.9, almost 14 million, right? And then we have our fuel expenses, which is part of your operating, your maintenance costs, rent and landing fees. Then you have other costs of revenue. These are direct costs. You have a gross profit of 2.2 million. Okay. So that looks good. It's profitable, gross profit wise. Then you have operating expenses. At the end of the day, you have a net profit, which looks good, right? But then we look at all those other things like, okay, well, how much of that did we get paid? How much cash was collected in that? All right. So those are the things that we want to look at: the cash collected versus the cash not collected, versus expenses not paid, like accounts payable that we didn't have to pay right away, versus cash outflow to things that we had to spend money on. Okay. Those are the things that really impact account operating cash flow. Now, the other part of cash flow is cash flow from investing. So investing inside of the trucking industry, if you're a truck fleet owner, we know that investing is going to comprise of going out and buying equipment. That's what investing is for the most part. That's really the highest investing activity that you can do, is adding another unit onto the fleet, because another unit equals more revenue that you can bring on, right? And we want to understand the timing of it, because if you are not positive cash on other components of cash flow, then when you dish out cash, right? Dish out cash, it's going to have a real severe impact to your ability to maintain operating, right? So the idea here is to make sure that there's a balance here where you can continually flourish and operate the business into the future, all right, from every decision that you make. Because at the end of the day, you want to make this a cash cow overall. Now, these are important components to understand, component parts of cash flow to understand, because each one impacts the other. So if I take money out of my bank account, this is cash flow from investing, guys. If I take money out of my bank account and I take that money and I go purchase a truck at an auction, cash money at an auction, well, that has a negative impact to my cash. All right. There's an investment there into the future, which is fantastic. But is that impact that you're making detrimental to the company? Okay. Now, when we get into reading balance sheets and understanding like equity and liabilities and all those things that comprise a balance sheet, then we know whether or not the company is really, really healthy inside of the decisions it's making. Because if you're upside down, when upside down means that I just borrow more money than what I have in the company, and that has multiple ramifications to it, to the financial health and to your own personal health and your personal financial health, and your business financial health, and then for your tax position. So there's negative ramifications surrounding that we want to get present to. All right. So the idea here is to make sure that you know exactly like that the decision to invest in a new piece of equipment into the future of the company is going to have a positive impact all the way around. Right. Like you're healthy enough to sustain that outlay cash wise. Right. And if you're taking on financing for that, like external financing, like a loan or liability for it, we want that to make sense too. Okay. But cash flow from investing means, number one, I am putting money into equipment. I purchase it, right? So cash goes down. All right. And if I sell off any equipment, cash goes up. That would be a positive impact to cash flow if I sold off equipment. So maybe you're selling off equipment in order to purchase another piece of equipment that'll perform better. It's actually not costing you as much in maintenance, right? So you're able to invest more so into a vehicle, a piece of equipment that's not going to cost you as much in fuel or maintenance. Well, that makes sense. Okay. So you're trading up. You're selling off one asset, cash goes up, taking a portion of that, and cash goes down by that portion, but it ultimately go down by another portion. You have financing from that, and it works. You have financing and to add to that was what I mean. And that's what works. Okay. So that's investing. The purchasing assets, selling off assets in the business. Okay. And an asset is like buying a truck or buying a trailer, even buying a piece of land. Right. But guys, every decision that we make inside of investing, it wants to be a positive income generating and cash generating outcome on the other side of that. All right. We want to know that that's going to produce a return, is what I want to say. All right. So the last part of this is cash flow from financing. So you see me here. I just talked about a balance sheet a little bit. I'm reading a balance sheet, and this is what a balance sheet looks like. It's just that formula: assets equal liability and equity. Assets equal liability and equity. Okay, so debt is liability, and then we have equity. Equity is like the money that you invest into your company and the profits that it continues to generate, positive profits or negative profits, right? That's still equity. Okay. Now, like the thing about being upside down, this is what I talked about before. So I want to talk about being upside down. All right. Decision making. All right. I'm clear that if you're here in this conversation with me, that you want to have a successful and long lasting, profitable, cash producing trucking company or and you want to do well. Okay. That's clear. Now, in order to do that, there is a responsibility that you have to making sure that the business remains healthy. The balance sheet will let us know that if that business is healthy, and being upside down is an indicator of the business is very unhealthy. It's like very sick. Okay. And what does it mean to be upside down? It means that I have negative equity in my business. Business is redlining, and you need to bring it back fast. It's like we need to make some real decisions to turn that around so that the equity is now positive, all right, and growing in that direction, all right? So what causes negative equity? Borrowing money, right? Continuing to borrow money, continuing to do credit lines where there is no invested interest of the owners into the company, right? It's all debt, okay? So everything like your cash on hand, your accounts receivable, your fixed assets like your trucks and your trailers and property, all of it has been financed by debt. And then you have less of the asset base, all right? Less of the asset base than you have debt. That turns you upside down, all right? So you have more debt than you have assets, which means you have negative equity. How does that really happen, though? Well, it happens when the company loses money period after period, or if the owners extract money time after time after time, or a combination thereof. Okay. So I'm talking about this because this is one of the major I guess it's a pitfall, is what we want to call it. It's a major pitfall amongst fleet owners, because we just pay ourselves whatever we think we should pay ourselves, and then the company suffers, where we want the company to thrive so that it can continue to pay into perpetuity forever, right? We want that company to keep going forward into time and be healthy, right? But those decisions on how you as an owner extract money from the company is a financing activity. Like I'm taking money, you take money out of that company, that's an impact to the company's cash flow negatively, okay? You borrow more money, right? But then you have negative equity, right? It just makes it unhealthy. So you try to solve the problem by borrowing more money, but that's not really a solution, not a long-term solution anyway. It is really a setup for disaster down the line. So what we want to do is make sure that, one, you understand like the impacts. Like, okay, if I'm going to take money out of my business, this is the impact of me taking money out of my business in this way. It's actually going to cause me to be upside down. Is it really going to cause me to be upside down? If it is, then we might not want to make that decision. All right. Utilizing the assets. How are we using the assets in the business? Are they returning a profit? Are they actually increasing the equity of the company when that asset is performing? That's the question we want to ask of ourselves. Okay. Now, there are other things that we can talk about inside of cash flow. But the thing I want you to be left with here, that there are three components to cash flow that you really want to understand. Okay. And each one of those has activities that have a correlate impact to the activity that you take on in one of those components. So we have cash flow from operating, cash flow from investing, and cash flow from financing. Okay. All right, guys, hopefully that was helpful. At least it sparked up the concept for you for you to know more about how this will work inside of your business. It's been great being with you today on a Monday evening. All right. So next time, I'll be looking forward to speaking with you next Monday on March 11th, 2024. Take care, guys. Have a great night. See you then. Take care. Bye-bye.